Hey, 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 it's your boy, Fat Albert. Oh, baby. We're back again, guys. Welcome back to the channel. What is up, everybody? Welcome to Trades, where we have technical analysis on different stocks in the stock market, as well as potential buy, hold, or sell opinions on these given stocks. I'd like to preface by saying that I'm not a financial advisor nor expert, so take what I say with a grain of salt. Let's get into the video. Today, my friends, we're going to give you guys an update on my particular game plan in regards to the AMC's situation, the gamma squeeze, the short squeeze, the whole 9 yards. So, we're going to give you guys a very basic rundown on why this gamma squeeze is so important, what we can do moving forward, or what I'm going to be doing moving forward to kind of attribute to the cause, right? And then you guys can make your own financial decisions based on that alone. So one thing that I do want to say right off the bat is options are risky, right? Options are essentially betting that a stock will go up or go down, and if it does not do what you desired, right, you can walk away with none of your initial investment. So I really do urge anybody who is not comfortable with options, anybody who is not a well-versed investor or trader, to stay away from options and solely trade the stock, hold specific shares in the company, right? And that will treat you pretty dang well. I do, as you can see, have a position in AMC of 1,367 shares at a dollar cost average of 845.7. And I've been adding my position as much as I can, and options are going to be a way that I decide to do that. So we've got quite a bit to talk about here. Let's get into the video. I've thrown together a very mediocre, slideshow, and I want to just address this. So, as I just mentioned, don't play options if you're new. TT, that's me, Trace Trades, wearing these stupid glasses. All right, so anyways, options basics. What do we have here? So basically what you have for options basics is a bet that a stock goes up or down. So what you're doing, if we come over here to call options, right, we just check this out on AMC, we've got calls. So looking at a $10 call, essentially what you're saying is, hey, I think that by 5th of March, 2021, AMC is going to be more than $10, right? You would pay 57 cents per share for the premium, which would come out to $57 for a total, one option contract share of, $10 strike, right? So that's what you're betting on. You're betting that a stock goes up. On the flip side, you've got puts. So you'd be betting, hey, I bet that the stock price is going to be underneath $12 by 5th of March, 2021. You'd pay $465 per share for that, right? And that would come out to $465 for that single contract on the put. So you're betting that a play or a stock will go up or down. Calls are bullish in nature, meaning you think they're going to go up. Puts are bearish in nature. That means you think it's going to go down, right? And then I've got in the money, out the money, and at the money. What do these mean and why is this important, right? In the money refers to a strike price that's underneath the market value. So as an example, if you come over here to AMC, which is currently trading at $8.20, very simply put, right, you've got $8 strike in the money at $1.01. And that is basically saying, hey, I think that the price on 5th of March 2021 is going to be above $8. That is an in-the-money play because as of this moment, it is trading underneath $8.20, the current market value. At the money refers to being, specifically at the money. So perhaps a better example would be, if I referred to $6 as in the money, $8 is pretty close to at the money. It's very close to that $8 strike, right? Then we've got out the money. This is essentially a strike that is over the market value. So it's trading $8.20 right now. If I were to make an option call and say, hey, I think it's going to be over $15 on 5th of March, 2021, I am betting on the fact that it's going to be above the current market value price, or it means that this play is currently out the money, right? I'm not up on my investment in this stock as of yet. And you're going to see a direct correlation in plays that are in the money, very deep in the money, and also, plays that are at the money or out the money, right? The premiums are going to look a whole lot different. And we're going to get into that more in a little bit, but that is, a basic overview and something that I want to point out. So what is the importance of this, right? What's the difference in risk and premium? Or as I like to call it, insurance, right? So in the money, you've got a higher cost because there's low risk of you coming out the other end of this. There's a very, very high probability that you end up making money on your play. So for example, if we look at the 0.5 options contracts expiring on 5th of March, 2021, those are very, very deep in the money, right? The odds of you coming out the other end without, being, having won that essentially call option are slim, which is why you would pay $7.70 per share for that contract, right? So in the end, you're paying, just a little bit less for those 100 shares if you decide to exercise than you would if you bought them at market value. And that's because, right, the chances of you coming out on top are very high. So that very well reflects in the price action. For a better example, 5.5, there's still a pretty good chance that you come out on the right side of that, right? If you made a 5.5 call option expiring 5th of March 2021, which is why, it's still a little more expensive, but it's less expensive than 0.5 because there's less of a chance that it ends, above 5.5 comparatively to that 0.5 contract, right? So as you go up, in price, the price for the premium is going to also reflect on that. So it's going to go down in price. On the flip side, we've got at the money, is going to be, a moderate cost. It's got medium risk. Out the money has a low cost and high risk, right? So if I was to make a call option on the 20th of March, 2021, it would cost me 21 cents a share, or $21 if I decided to exercise, or just to purchase that call option. What I would be paying if I decide to exercise it, though, would be that $20 per share. I'm essentially locking in that price, saying this is what I'm willing to pay, right, for this contract, saying that I can, if I would like to, purchase 100 shares at $20. Now, don't pay too much attention to this right now. We're going to get into the weeds a little bit more here. But the higher the premium, right, the less risk is involved. The lower the premium, the more risk is involved, right? So we need to point that out right off the bat here. You've got a bag holder, right? So there's a higher chance of being a bag holder if, you make a call that is out the money. You've got a case holder, which is essentially a higher chance of you coming out on the other end and making money, which is typically tied with those lower risk plays. Now, what's the importance of expiration and premium? So a further expiration date means you're likely going to pay more premium. Now, let's just use an example here. If we look at the $10 strike expiring on 5th of March, 2021, you'd pay 57 cents per share for $57 total on that one option contract. Now, if we look at that $10 strike on the 12th of March, 2021, you're going to pay a different amount. It is $1.06 per share, which would come out to $106 per contract. The reason for this being, the longer that you play a stock out, the more chance you have of becoming profitable in that play, which means you're going to pay an overall higher premium, right? So that's something to keep in the back of your mind. If we take that same basis, right? That same fundamental overview, the closer the expiration, the lower the premium is going to cost, because there's less chance of you coming out profitable on that trade. The price goes up, the more likely you become profitable. So typically, this is very obvious. You got high risk, there's high reward. Think of think of Bitcoin, low risk, low reward. Now, I shouldn't have drawn Doge there, but I just think it's funny. You get the picture. So we're going to come over here to delta hedging and the gamma squeeze. And why is this important, right? This is what I wanted to kind of discuss in regards to call options, and why I think it's important to talk about call options in regards to a possible gamma squeeze with AMC, what we can do moving forward to really help drive the price action, or at least what I'm going to do moving forward to help drive the price action, right? So you've got Hedgie over here. Hedgie is a market maker. Market makers have to essentially hedge or cover their gamma or their positions, when call options come into a play, right? They need to manage risk. They need to manage the collateral. So if we look at the 5th of March, 2021, you can see that there's a crap ton of call options that have come in. You've got a bunch between, 50 cents and I would argue $15. There's a huge amount of unusual call option trading taking place. So Hedgie over here, he doesn't need to necessarily disclose when he buys or if he buys, right? He could decide to buy all of these at the last minute, right before all these call options expire. Wouldn't be, recommended, but he can. So what he does to mitigate his risk is he decides, all right, we've got let's just say 200,000 total call options, which is worth 20 million shares. He says, crap, if I have to have the collateral for 200,000 call options, that comes out to 20 million total shares. And I better make dang sure that I've got these shares. Now, where do they purchase these shares from, right? In case, by off chance, people decide to exercise these options. They come from the market. They come from the market 100%. So in order to mitigate the risk, they do something called delta hedging. Delta hedging is essentially something that helps drive the stock price and can cause a gamma squeeze, because regardless of the intent, right, he's still purchasing those 20 million, shares at some point or another. Now, you're not going to see this come out as, 20 million straight shares that are driving the price action all at once, which is why I'm going to lead into the next point here talking about Monday, but it does drive the price action. It can take place over a significant amount of time. So as there's continued unusual options trading, right, these market makers need to mitigate the risk. They need to have the collateral or the shares available to help drive this price action forward, which is why when you see the call options on, let's say, GameStop, right? GameStop started out as a gamma squeeze that moved into a short squeeze. You had a crap ton of call options take place between $20, push it up to $30, push it up to $45, bounced around a little while, came up to $46, came up to $99. Short squeeze begins, right? That gamma squeeze helped push into that short squeeze because of the unusual call options trading, right? That essentially market makers had to delta hedge, right? They had to manage their risk, which is what you're seeing take place here, right? So that's very, very significant. Now, why does this matter moving forward, right? Because it's essentially you can drive a gamma squeeze by continuing on with this unusual option call trading. So what is something that I'm going to personally be doing, right? What is Trey's Trades, personal game plan in regards to options? Well, I plan on doing myself. This is not financial advice. Don't do what I do. Don't see as I do, right? Whatever. You make your own decisions, but based off of the information that we know, what can we do to drive the price action forward? We can continue to buy call options. So some call options that I'm going to be doing, some in-the-money call options, right? So based on that, in-the-money call options expiring on, let's just say, 9th March 2021, or 5 March 2021, as I was. So I'm going to come back here to AMC, and I'm going to show you what I've been keeping my eyeball on. So some call options expiring on 5th of March for the $6 strike. This is an example of something I find interesting. I would pay $2.23 per share or $223 for a single option contract here on this stock, right? If you take 223 times 100, because there are 100 shares here, you get $223. Just move 2 decimal points to the right. So that's what I'd be paying for this premium right now. And that catches my eye because the risk for this is relatively low, right? And if I decide to exercise it, I have the opportunity to purchase 100 shares at a strike price of $6, which would actually lower my overall dollar cost average on the stock, right? Which helps me out, and it also helps out the situation with a gamma squeeze, because what you have here is the market makers, Hedgie still has to match the collateral because I plan on exercising that option call. I plan on lowering my overall dollar cost average, right? So he needs to purchase shares so that I can purchase shares if I decide to exercise it, which I plan on doing, right? To match that call, right? So you can see here we've got 32,000 call options which need to be delta hedged to begin with, right? So me adding to that, personally, you're going to see the market makers need to match that by delta hedging. So my personal in the money call, or my call options that are currently under the market value for their strike price, I am focusing on that $6 premium, not premium as I was, strike price, the $6 strike. And that is because the risk for that is relatively low. And I can, help out in a couple different ways. I can lower my overall dollar cost average if it stays above $6, solely dependent on that, right? It would need to close above, my break-even price in order for me to come out on top of that, right? So you can look at a bunch of different options calculators that'll tell you the math. If you'd like to check that out, all you have to do is Google options calculators, but there's pretty good chances that I come out on top there. Now, if you want to lower your overall risk even lower than that, you can pay a higher premium, right? $2.61 per share for the 5.5, $3.25 for the $5 strike. You get the picture here, right? But that's still, if it closes above that $5 strike, you have the obligation and the opportunity to purchase those 100 shares at that strike price, which is huge. So that's what I'm going to be doing personally. I'm going to be buying some in-the-money call options at the $6 strike, maybe the 5.5, expiring on March 5th. And that is going to be a short-term, goal that I have to help drive some price action. Okay, so that's number one. Number two is some out-the-money call options. And why would I focus on these if they're a little riskier, right? Well, you can mitigate that risk in a couple different ways. So I would not buy call options expiring on the 5th of March 2021 that are way out the money. What I'm going to be doing is looking out here to June, September, and purchasing a higher premium for some call options that have a little less risk involved, right? So if you look at the strike here of $2.08, and we compare that to the $6, right? It's relatively close to the same. And that is because the chances of me coming out on top on this out-the-money call option are pretty high, right? Now, why is this important? Because you're paying the same strike for a higher overall, strike, or the same premium, I should say, or actually a little bit cheaper for a higher strike, which is going to force market makers down the road to purchase more of these call options, right? So they're gonna have to hedge. They're gonna have to match the collateral. They're gonna have to have shares available in case, by the off chance, I want to exercise those plays, which I most likely will do. Right? It adds to the cause. So in a very dumbed down way, if I were to purchase 5 contracts, right, 5 options contracts, whether they're in the money or out the money, you have 500 shares total. So you have market makers that need to have collateral for 500 shares by the off chance that I exercise these contracts. You don't necessarily have to go one way or the other. You could go in the money or you could go out the money. The big difference being out the money premiums are going to be cheaper than the in the money premiums. There's less risk involved with the in the money, option play. There's more risk involved with an out the money option play. So this is where I say, and this is why it's so important, guys, that you are an experienced investor if you decide to play with options contracts, because you are betting that a stock will go up. I really, really, really urge you guys to be very careful and cautious if you're not an experienced options trader to not play with this, right? My personal game plan is to purchase some of these $6 strikes and some potential $15 strikes or $20 strikes or $25 strikes that are way out the money, right? It's nowhere near that current strike price. And honestly, if I wanted to, I could go even farther up than that. I could go up to, $40, and I would pay $1 per share, which would be $100 per contract. Way out the money, right? You've got a lot of opportunity over time to make that money back, right? To actually capitalize on it if there's a gamma squeeze or a short squeeze or whatever it may be, right? But it still forces these market makers to have to purchase, the collateral that would match up with each of these options contracts. So that is what is essential, and that is why I say in my previous video that we checked box 1 by closing over $8, right? We have begun the potential for a gamma squeeze. So what do we have here? We had a bunch of options contracts that expired in the money, right? Meaning that there are traders out there that have the opportunity to, if they'd wish, purchase, if they have the collateral as well, purchase 100 shares at that designated strike price. That is factual, right? The market makers, it's possible they already hedged. It's possible they already hedged, right? Maybe they haven't. Maybe they will on Monday. Maybe you have that with a small amount. But the real, big dinger here is that you're going to have, a significant amount of options contracts exercised that are purchased at market value coming up on Monday, right? Whether it's 10%, 20%, 50% of those total options contracts that expire, you have that there is going to be, I shouldn't say market value, at that strike price, right? So at that strike price, they're going to hold those shares and they're going to be purchased. So that's going to affect the stock price. That's box one. We checked box one. This is box one getting checked of that the gamma squeeze potential, right? So to continue this, what is the momentum moving forward? We have to have continued options contracts that are being purchased, whether it's in the money, out the money, at the money, right? This all contributes to the cause because delta hedging takes place, right? These market makers purchase those shares at market value in order to mitigate their risk, and that drives the price action up. I've seen some people that have been speculating. They say, Trey, was it possible that we saw a little bit of a gamma squeeze already, from $5 up to $11? And it's possible, right? That would be a 100% gain. That'd be a 100% gain, and that would explain why you're seeing some of this hedging taking place, why you saw some of that price run up, right? But that would not explain why we saw a significant sell-off, right? So the short positions here are still 100% relevant, right? I think if this was a gamma squeeze, it was a relatively small one. This is nothing in comparison to what we saw take place with GameStop or AMC in the past, but nonetheless, it was a setup, right? We're getting set up for that next huge possible run. Now, there's nothing guaranteed about the situation, guys, but there is a setup 100% there. So to continue, right, what are we looking for? We're looking for that gamma squeeze to essentially eventually lead to possibly another gamma squeeze, possibly to another gamma squeeze, as many times as it takes for short positions to cover their positions, to say, oh crap, oh my God, I am way out right now. I'm getting crushed. I've got the potential for infinite losses. If this keeps running, I'm going to get crushed, so I better cover my positions. And that can lead to a short squeeze, right? So that's the next box to check. And that's what you saw take place with GameStop, right? GameStop got short squeezed. GameStop got absolutely squeezed like a lemon. She got run to the moon. She got crushed. And the potential is 100% there with AMC. Something I think is significant, and I've seen this talked about quite a bit. We're going to kind of flip gears here. Is a huge buyer that came in at the end of the market day on Friday. We saw about $8 million of total stock that was purchased. It was somewhere around 900,000 shares, which would actually be more than the 10th highest owner currently of AMC, which is LMR Partners LLP. Which raises a question. Was this an institution that stepped in, or was this a retail investor that stepped into the stock and helped the cause? It's very possible we saw this be an institutional investor, right? Something that raises a little bit of concern is the fact that it was two back-to-back $450,000 share stakes that were taken. But nonetheless, whoever made those purchases are now the 10th highest owner of AMC. Look at all these huge stakes that are currently being held in AMC right now. 7.5 million shares, 5.6, 4.6, 3.2, 2.1. You guys get the picture here. It's astronomical. These are huge stakes that are holding AMC. Okay, the mutual funds holding AMC. We've got a lot here as well, right? We've got 2.3 million. We've got 1.9 million shares. We've got 1.7 million shares. The point being, there's some big names right now in AMC that are holding stock, and the potential is 100% there to keep this movement going. I don't think you would have seen that 900,000 share stake being taken at the last second of the bell. 801, 80 freaking 1, baby, if this was not a still alive ball. Not a dead cat, not a dead cat, not a dead cat, not a dead cat. You get the picture, guys. This is huge. This is such big news. And honestly, guys, this is so simple, right? This is so simple. To continue the potential for this to run, you need two things. You need a continuation of short interest, which we have. We have high utilization. You need a continuation of unusual options trading. And honestly, a third thing would be you need a continuation of people to hold and buy this stock, right? All of these things contribute to the overall cause and the potential for this to have a crazy run up. So that's my personal game plan, guys. Coming into this on Monday open, I am 100% planning on coming into this and purchasing some in the money and out the money options contracts. The in the money ones, March 5th, right? I'm going to buy either 5.5 or the $6 strike, whatever, I feel is best at market open. I'm going to buy some out the money options contracts that are further out on expiration so I can mitigate my risk, right? Have a high potential for growth because we don't like gambling in the market. We're not here to do that, right? We're here to make as much educated decision making as we can so we can set up for a solid potential for a gain, right? And that's what we're looking at. So that's what I wanted to touch on the most here in this video. I'm going to just show you a brief overview of the Ortex numbers in regards to AMC. We're going to see if there's anything that's significantly different, but I anticipate it's not, and sure enough, it is not. We've got 93.9% utilization, meaning that only 6.1% of the total utilizable short lendable shares are available for shorting. That's astronomical. Days to cover here is a very skewed number, and I saw this on, maybe it was Discord or Stock Twits, but somebody was talking about the days to cover if you change it to a 1 month average volume, and it was like 2.65. Why is that important? Because the higher days to cover, the more difficult it is for shorts to come out positive on their positions. So that's huge. That's a huge thing to keep in the back of your mind. We've seen the cost to borrow has been going up as well, according to Fintel, right? If we look at the AMC short interest, right? You can see there's a significant amount of interest accruing on these plays. 4.29%. It was at 6% at one point on Friday, right? So this is going up because there's more risk for shorts to hold their positions, which just further affirmates our consensus, which is there is still live action. This is not a dead cat. There's still potential for this to squeeze. So that is what I've got for, what I am personally planning to do to help drive the price action here to play this as best as I possibly can. So just give you a quick recap, I'm going to be purchasing some in the money and out the money options contracts. I'm going to continue to buy and hold, right? And I'm going to keep you guys updated with everything that I can in regards to the short interest. And that is what I have for the video today. If you enjoyed it, please drop a like. It really does help support the channel, and consider subscribing if you'd like to see more content like this. Lastly, I have an affiliate link in the description box down below for Webull. This is version 4 for the desktop. Great platform that allows you to start trading at 4 a.m. in the pre-market. If you use my link, you get 2 free stocks with a $100 deposit. I'll receive a free stock. Great way to support the channel, my friends. And if you're not interested, that is totally fine. I just appreciate your support by taking the time to watch my videos. I also have a link in the description box to the Discord if you'd like to join a community of people. I am not able to knock out videos on every single stock I talk about every single day. We've got a community of great people out there that know exactly what they're talking about. If you'd like some help, some educational opportunities to join an awesome community, that is available for you as well. And there is a link in the description box as well to the merch store if you'd like to check out a Gorilla Gang mug or a shirt or whatever it may be. So that's what I have for you guys today. Thank you for watching, my friends, and I will see you all next time. Peace.